Okay, so I'm really excited to talk with you today, Zach, from the Asbel team. It's interesting because we were talking about the fact that this isn't necessarily something that you and I specialize in, but it's definitely something that it affects our buyers. So we thought it would be a good topic to help people understand about a HELOC. Like, when is it a good idea in Utah, to use part of your equity for something other than, you know, just having it sit there. So, why don't you go ahead and introduce kind of some of your thoughts that you were thinking about the HELOC, like when we should consider getting a HELOC and maybe kind of what some of those tools are.
Perfect. So one of the interesting things I see almost every week is certain people should have a HELOC that don't have a HELOC and they wish they had gotten it earlier on. And so when I look at that, the biggest thing we've seen is property values have gone up significantly, right? Over the last 4 or 5 years, anybody who purchased a home likely is sitting on a good enough chunk of equity that they could pull what's called a home equity line of credit. Now, typical home equity lines of credit, usually they have a specific amount of draw time. Most of those that we see are usually a 10-year draw period. And so you're able to draw from that as much as you want, um, within whatever they set up for the HELOC. So let's say you have $100,000. They'll say, okay, here's your draw limit. Pull from your 100,000 as you want for the next 10 years. And then once that 10 years is up, they typically then put it into a 20-year term. And so then you have 20 years to pay off whatever that remaining balance is that has been withdrawn. And so it's a really good thing. What we're seeing sometimes right now too is like if you're fearful that you're going to get laid off in the next 6 months to a year or something like that, it's a great thing to get ahead of that and say, okay, well, let's go get a HELOC because we'd much rather borrow at a rate of 6 or 7% versus turning to credit cards that are in the 20% range. And so there's almost ways to strategize just certain things like that that just really make a huge, huge difference if somebody were to be let go of. Hard thing too is if you get let go of, the bank's not going to want you to like they're not going to give you a home equity line of credit, right? They're going to say, well, get a new job and then we'll take a look at this. And so it's kind of one of those things that you can just strategically set up so that if there are any hiccups, you have you don't have to deal with that.
That's interesting. So it's kind of like taking so this line of credit can actually work. I mean, it's not like a credit card, but it's kind of like a credit card because you can leave it at zero balance. So, like,
Right.
someone can go out, get a home equity line of credit, and then they don't have to use a dime of it, but it's just like a safety net. Does that affect your
Exactly.
credit if you do that? If you go out and take, let's say you did take 100,000 but you don't use it in it. Does that affect your credit in any way?
It would show as like a newer installment that's there, and so that might ding you a little bit just because there isn't the length of time. But if you're at a zero balance, I think it'd be so minimal as far as affecting your credit that it wouldn't be a huge deal typically.
Okay. Well, I like
So
that because, I mean, then if there was an emergency, like you said, you can borrow against your own money and pay a much smaller percent than dipping into a credit card that obviously they're gonna get you coming and going on credit cards.
they are. And so these are the things that we look at too is like predictable incomes, what they're going to want to see. They're also going to want to see a strong equity position where you have 20-30% equity. Most of these are, at least that I'm seeing right now, probably go to an 80 to 90% loan to value ratio. And so the way that that's calculated is they'll look at what you have on your first mortgage minus whatever the home is worth, and they kind of back into like a 80 to 90% loan to value and say, okay, if you own a home that's worth a half a million and you owe 300,000 on it, likely they'd give you around 100,000 of, you know, of a line of credit. So
And I have seen, like, I know that they establish that typically through an appraisal. And what I've seen in real estate is that they're very generous because they figure if you're doing a line of credit, you're not going to be selling right away. So when we use this as a tool, we have to make sure that we're not overextending because so if someone uses it short term and then they're going to sell their house, they might be in trouble numbers wise. So I know we're going to talk a little bit more about that, but I did want to make the point that the appraisers, especially here in Utah, like they're very generous if you're going to do a line of credit against the house. So typically they kind of over appraise, you could say, or just give you a really good number to help you meet your goals. But you have to be careful with that as well.
Right, definitely. And that's where it's helpful to kind of get that CMA from you, right, Janet, where they can have that CMA to say, okay, this is probably where we're at. Let's not overextend it, but like let's go to that, right threshold so that we're kind of protected from it. The nice thing too about HELOCs is, at least for that first 10-year period, it's typically an interest-only payment. So let's just say you borrow 100,000 at 7%, like that monthly payment comes out to right around $583 per month because it's an interest only payment. And so a lot of times we'll see people do debt consolidations with the HELOC, where if they do have, 10, 20, 30, $40,000 of credit cards or more, sometimes they'll just say, well, these payments are just so much per month that if we can just roll it into a HELOC, we're now getting out of the 20% interest rates going into the sevens, and then we're also able to get the monthly payment lower. And so it just gives people breathing room where they can now start to pay down the principal, and kind of just get ahead of it. So that's probably one of the best things that we're seeing just in terms of the debt consolidation portion.
Yeah, that is a great suggestion.
Now, when it comes to refinancing, real quick, um, if you think that you're going to refinance in the next year or two, I would recommend not getting a HELOC, because what happens is they look at something on when we do a refinance called the CLTV, and it's the combined loan to value ratio. And so they'll take a look at that, and if you have a higher CLTV, you don't get as good of interest rates because it's riskier from the lender's perspective. And so part of me would almost say if you're in the 2 to 3%, maybe even the fours, likely you're not going to refinance that in the next year or two. Makes sense to get the HELOC. If you're in the, sevens or sixes, you might even just say, yeah, let's put a hold on doing the HELOC for now. Get the refinance, and then after we do the refi, then you could then go pull that HELOC, and that could be a, good strategy as well.
Very nice. Very nice. I know that we've used this sometimes, like, well, especially this scenario where you have a client who's like, I really can't, like, I had a client, they had 8 kids. And
Wow.
they were like, we can't really show our house. Like, we homeschool our kids. It's crazy. It's madness. So they really, really needed to find something first before they sold. So that would be kind of like what we're talking about right now, right? So how does that work for someone?
So what they would typically do is they'd pull that home equity line of credit, and that would be used as their down payment on the next home. And they'd essentially have to qualify for both homes potentially. But it's a really easy way to do it, to access that equity, pull it, use that as down payment, and you can then just list the home after you've moved into the new one. And it makes it a really simple process, right? Because you're not having to time everything, down to the day. You're able to kind of take your time on the move and make that transition probably a little bit smoother.
Yeah. Yeah.
Renovations are another big thing though, right? Because sometimes if you come into a home, Janet, you might see, hey, if this was updated a little bit, this was painted a little bit, it could bring in a better value and, a better, more offers. And so that's another thing that I think of with HELOCs is oftentimes with your eye, Janet, you can probably say, man, if we had $10,000, it would almost get us another $20,000 on the sales price where we could, have multiple offers because of the way the home shows.
Yeah. Yeah. And I had a client in Lehigh that was looking to do it with a listing. It just needed a refresh. Like it was time for, fresh paint, fresh carpet, those kind of things. So it is a great idea because when you don't have the cash in the bank to do that, it's a great way to get that done so that you can, it's also going to help with how quickly the home sells, because a home that needs new everything, there, it also includes a little bit of an odor with it if it needs new everything, and not the good kind. So it is nice to have a line of credit that you can borrow against to get those things done. So yeah,
And that has been interesting with this market, right? I feel like as I watch listings hit, I feel like some are hitting and they go under contract within the first 10 days. And it's always the turnkey, ready to go, don't need anything fixed kind of ones that are going, significantly quicker than, the ones that do need a little bit of extra help.
Yeah,
So,
absolutely. And everyone has their own scenario. Like I was just talking to someone this morning and it's her dad's property and she just said, when you have a trust, you have multiple family members involved. Everyone's just like, we're not going to do anything. We'll remove the items that are in the house. And I'm just like, let's just give it a really nice cleaning and then we'll just price it accordingly, right?
right.
If you're owner occupying it and you're really trying to maximize what you're taking with you to your next house, you might want a different strategy, and that's where the home equity line really helps. So that's good information there.
Love it. Now we get to go into the bad times to use a HELOC, right? And so there's a lot of different ways to use a HELOC. Part of me says we almost want to have a plan when you get the HELOC of what's going to happen with it, right? Whether we're doing a debt consolidation, whether we're just leaving it there at zero as a safety net for the what ifs in the world. Like we really want to go in with a clear plan because what we sometimes see is people end up saying, "Oh, I've got $50,000," and it burns a hole in their pocket. And they're like, "Okay, well, we're going to spend this on travel. We're going to spend this to get new vehicles. We're going to do some shopping sprees." I mean, I've even seen some because, as we're refinancing, sometimes people even just live off of these, right? They see that, hey, you know what, I can basically pull $1,000 a month from this and have that extra $1,000 to live on. And that's not the way you want to treat your HELOC because if you treat it like that, it can be a pain. We actually had one client specifically that they bought their home in like 2021 and it was a great house. They got a really good deal on it. And then the equity went up in it. They bought it for like 350. It then moved up to 450 when they did their HELOC appraisal. And they said, "Oh, perfect. We've got 100 grand that we can pull from." And they ended up spending that 100 grand on just daily living expenses, dog food, and motorcycles, just different things. And as they did that, when it came time, like in 2025, when they're like, "Hey, we're finally ready to get into a different house," this the options that were there for them just were so less than what they were hoping, right? It was bleak. They were hoping to be like pulling out 100,000 of equity and selling it, and it's like, well, we used that 100,000 of equity when we pulled that HELOC and used all that money. And so you really want to be careful with how you spend that and just not get into bad habits. So,
Yeah, for sure. I mean, I think that the biggest problem that happened like in 2008, 9, like around there is that people they would say, "Well, you're not supposed to use your house like an ATM." Because
yep.
so many people were like, "Hey, we've got all this great equity bump and everything. I'm going to get a boat. Pull that equity out of the house, get a boat, Oh, I'm going to go on this I've always wanted to go on a cruise. Pull the money out, go on a cruise." It's not money that you can recapture. um, One thing we didn't talk about that I do want to go back to is investors. Like someone who's wanting to get an investment property, having access to that equity as your down payment, it's also an excellent opportunity for investors to be able to use their money, their own money, to be able to get them into additional properties. So that's another positive way. We've been quite negative, but there's other positive ways. So stick that in there real quick.
Right. Well, that's a beautiful thing too with it being an interest only payment. Sometimes it helps you to get better cash flows off of it. And so there's so many different ways with that HELOC with investors that it just helps them to get to that next step and get the cash flows that they want to see. So,
Sorry about that. It looks
oh,
like I clicked right through all of our things. I'll just go back to it. Forgive me. We were right here.
so then as far as if your budget's already stretched and you're not doing a debt consolidation to like get payments down, it might not be a good idea to get a HELOC. That would be another one. And then if there's just no clear exit strategy, if we don't have that concise plan of what we're doing, best just not to pull it.
Gotcha. Yeah, that makes sense.
And then if you're also nearing retirement, that's another thing, right? Declining income, if you're thinking, okay, I'm only going to work for a couple more years, we might actually want to look at reverse mortgages versus a HELOC, just because it likely opens up more cash flows for you and, it's not a short-term band-aid.
Yeah,
So.
that's a good idea.
And then this just goes through the top three. If we're going to look at the minimum equity, you probably need to have at least 20%. We want to have 100% clarity on our plan and purpose. And then we probably want to have a timeline of 3 to 5 years that we think we're going to pay it off in. And so that just gives you a real kind of tight timeline to do it, but also keeps you safe by, having that plan in place. So.
Yeah, well, I really appreciate this education on doing a home line of equity here in Utah and when it is beneficial and when it's not. Because we've both shared clients where we've seen people use it well, people not use it well, and it makes a huge difference for your future. And I think that it's a long-term type of a thing that needs to be applied versus like short-term. If you think short-term, that's when you're going to get in trouble. If you think long-term, that's when it's beneficial. So I'm glad we had a chance to kind of go over that and review it and orient ourselves again to when it's beneficial to get a HELOC and when it is not. So thank you so much for your time today. I really appreciate it.
Awesome. Thanks, Janet.